Imagine paying for an insurance policy that promises lifetime protection, guaranteed returns, and a chance to build your wealth, only to hear that governments worldwide are suddenly cracking down on these very same products. Why would countries target something that millions believe is safe, secure, and even profitable? Are these policies a smart financial tool, or have they become one of the biggest financial traps in the insurance industry? Today, we're pulling back the curtain on whole life insurance, universal life, and investment-linked policies. We'll uncover why regulators in the UK, Singapore, Australia, and even here in the United States are starting to question if these products actually protect you or just expose you to hidden risks. For years, these hybrid insurance investment products have been sold as the ultimate financial solution. The pitch is simple. Protect your family and grow your money at the same time. You're told these policies can be your savings account, your emergency fund, your retirement plan, and your life insurance all rolled into one neat package. The marketing is powerful, the promises are tempting, and the emotional pull is strong. Who wouldn't want that kind of security? But behind the glossy brochures and confident sales presentations lies a much more complicated reality. These policies often come with very high fees that eat into your returns. Long lock-in periods where you can't touch your money without facing huge penalties, and complex structures that are difficult to understand. The returns you actually get often look nothing like the rosy projections you were shown. Now, after years of customer complaints, lapsed policies, and widespread reports of mis-selling, some governments are finally saying enough is enough. They're taking a much harder look at how these products are sold and whether they truly serve the customer's best interests. So, how do these policies actually work? Where does your money really go? Let's break it down. When you pay your premium for a policy like whole life, only a portion goes toward the actual life insurance coverage to the death benefit. The rest is funneled into an investment component, which the insurance company manages. This is the cash value part of the policy that's supposed to grow over time. The problem is, the fees can be massive. And investment management fees, all before your money even starts to earn a return. In the early years of the policy, these fees can be so high that your cash value grows incredibly slowly, or sometimes not at all. This is why if you try to surrender your policy in the first 5, 10, or even 15 years, you might get back far less than what you paid in. This brings us to the regulatory crackdown. In the UK, regulators have pushed for greater transparency on fees and commissions, forcing companies to be upfront about how much of your money is going into the salesperson's pocket. In Singapore, the Monetary Authority has introduced measures to curb mis-selling, including a balanced scorecard that assesses sales agents on the quality of their advice, not just their sales numbers. Australia has also tightened the screws, banning certain types of commissions that incentivized selling inappropriate products. These regulatory actions aren't happening in a vacuum. They are a direct response to a fundamental problem: a conflict of interest. The high, front-loaded commissions on these policies can incentivize agents to sell you the most expensive product, not necessarily the one that's right for you. They might get a huge payday, while you get locked into a low-performing, high-cost plan for decades. So, are these policies ever a good idea? For a very small, specific group of very wealthy individuals, they can serve a purpose, often for complex estate planning or tax strategies. But for the average person just looking to protect their family and save for the future, there are often much better, more efficient ways to achieve those goals. Consider this alternative. Buy term and invest the difference. You could buy a simple, inexpensive term life insurance policy that covers you for a specific period, say 20 or 30 years, when your financial obligations are highest. Then, you can take the money you save on premiums and it can be a lot and invest it directly into low-cost index funds or ETFs. This strategy gives you more control, greater transparency, lower fees, and historically, a much higher potential for growth. You're not locked into a rigid contract, and you can access your investment funds if you really need them. You get the pure protection you need from insurance and the pure growth potential you need from investing, without mixing them in a complicated and costly package. The story of these insurance products is a powerful lesson in financial literacy. Always ask questions. Understand the fees, read the fine print, and never be afraid to separate your insurance needs from your investment goals. If you have one of these policies, Don't panic. It's important to review it carefully. Perhaps with a friendly financial advisor who doesn't earn commissions, to see if it still aligns with your financial plan. Sometimes, keeping it might be the best option, but other times, a change might save you thousands in the long run. What you've learned today might just change the way you think about insurance forever. Thanks for watching. If you found this video helpful, please give it a thumbs up and subscribe for more content that helps you take control of your financial future. Have you ever wondered about the different types of life insurance out there? It's more than just a safety net. It's a financial tool. But with so many options, how do you choose? Today, we're diving deep into 3 popular types: whole life, universal life, and investment-linked policies. We'll break down what they are, who they're for, and why some countries are taking a closer look at them. This is the financial knowledge you need for 2025. Let's start with whole life insurance. The classic, the original. As the name suggests, it's designed to cover you for your entire life, as long as you keep paying the premiums. Think of it as lifetime protection. One of its standout features is the guaranteed cash value. This is a savings component that grows slowly but surely over time. You can even borrow against this cash value or withdraw some of it if you're in a tight spot. This makes it really appealing for people who want long-term financial security. Here in the UAE, many families choose whole life to leave a legacy or make sure their loved ones are protected, no matter what happens. Now, the premiums are usually higher than 4-term life insurance, but they are fixed, which offers a lot of stability in today's world. Plus, the death benefit is guaranteed. Your beneficiaries will get a set amount, and it's not tied to the ups and downs of the market. The downside: the cash value growth is pretty slow compared to other investments, and it's not very flexible. You can't just adjust your premiums or coverage on a whim. So, whole life is really for those who value safety and certainty above all else. It's a solid choice for estate planning and providing that lifelong peace of mind. Next up, we have universal life insurance. This is a more modern, flexible version of whole life. It also offers lifetime protection and a cash value account. But here is the key difference: you can adjust your premiums and coverage as your life changes. This is a huge plus for people with variable incomes, like freelancers or business owners, or anyone planning for big life events like buying a house or having kids. One of the best things about universal life is that you can use the cash value to pay your premiums, take out loans, or withdraw funds. You can even adjust the death benefit. This adaptability has made it very popular among expats and entrepreneurs in the UAE who want protection, but also want to manage their money more actively. But this flexibility comes with responsibility. If you don't pay enough in premiums, or if the cash value doesn't grow as expected, your policy could lapse, and you'd lose your coverage. The fees can also be higher, and they can eat into your returns over time. You really need to stay on top of your policy to make sure it stays active. Universal life is a great middle ground for those who want lifetime protection with some investment-like features and control. It offers a balance of security and adaptability, but it requires careful planning. Now for the high flyer. Investment-linked policies, or ULIPs. These policies mix life insurance with market-based investments. Part of your premium covers your life insurance, and the rest gets invested in funds like stocks, bonds, or a mix of both. This is for people who want the potential for higher returns and are comfortable with a bit of risk. In the UAE, these are a big hit with younger professionals and high-income earners. Why? They're flexible. You can often switch between different investment funds, add more money to your investments, or make partial withdrawals. Some policies even have features to protect you from major market downturns. But, and this is a big but, these policies carry significant risk. Your returns depend entirely on how the market performs. If the market does poorly, your cash value can shrink. The fees for managing these funds are also typically higher than with other types of insurance, and they can really cut into your gains. And if you need to pull your money out early, you might face some hefty penalties. Investment-linked policies are best for people with a long-term view who understand market risks and can commit to regular payments. They can be a powerful tool for both protection and wealth creation. But you absolutely have to understand the fees and risks involved before you sign up. So, with all these benefits, why are some countries starting to crack down on these types of policies? Regulators in places like Singapore, the UK, and the US are getting concerned about a few key issues: mis-selling, hidden fees, and unrealistic promises. Many people buy these policies thinking they're a guaranteed way to build wealth, but the reality is often much more complicated. A major problem is the high and often hidden fees, management costs, administrative charges, agent commissions. They all add up and can seriously reduce your returns. Some people end up paying thousands a year in fees without even realizing it. Mis-selling is another huge issue. Agents might market these as foolproof investments, downplaying the risks and the long-term commitment needed. Then there's the lapse risk. If you can't keep up with payments or the market tanks, your policy could collapse, leaving you with nothing after years of paying in. In response, governments are stepping in. They're demanding clearer disclosure of fees, banning high commission sales, and in some cases, restricting who can buy these complex products. The goal is to protect consumers and increase transparency. So what does this all mean for you? These policies can be valuable, but they require you to be informed and proactive. The global trend towards more regulation is a good thing. It pushes for more accountability and puts your interests first. It's a reminder to always read the fine print, ask hard questions, and make sure any financial product you choose truly fits your goals. Understanding both the potential and the pitfalls is key to making the right choice. For your financial future in 2025 and beyond, thanks for watching. We hope this breakdown helps you feel more confident about navigating the world of life insurance. If you found this useful, hit a like, subscribe for more content, and hit that notification bell so you don't miss our next video. See you soon.